Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for this Monday, January 24th. My name is Ian Saunders, and joining us as well today is David Clark. And David, we're coming in to this Monday first podcast we've had in a couple weeks, and there's been no shortage of movement to talk about over the last couple weeks. Coming in here this morning, we're seeing a further push to the downside from most of the major domestic equity indices after seeing last week being the worst week for domestic equity markets since the COVID-induced decline back in March of 2020. So we're going to start things off and take a look at some of the index support levels and some of the significant notable thresholds that have been violated with some of the movement we've seen over the past week or so. Kicking it off with the S&P 500. A good chart to look at for those that are following along on the platform is going to be the 100-point chart. That's one that we've been kind of focusing on Good chart to look at would be the 25-point chart for the S&P 500. We can see, looking at that as a little bit more kind of intermediate term movement instead of the near term kind of focused default chart there. And in looking at that, we saw that chart move to a sell signal with movement a couple weeks ago, when we see a continued straight shot down in a vertical column of O's down to a current chart level at 42.75 at the time of this recording on Monday morning. That is going to blow through support that we got back in December of last year. It's also now going to push through the support level that we got to in October of 2021. So the next support that we're really going to be monitoring from here is around the 42.50 threshold, which is going to be from July of last year. And then we see some further consistent support at 41.75, and then down there at the 40.75 level if it did continue to fall to that threshold. We're now at a 10% correction territory for the S&P 500. We're also in pretty heavily washed out conditions, and just from a straight absolute price movement perspective, trading down at the bottom of the 10-week trailing moving average that we see on the side of this chart page. We've also seen this decline in the S&P has not been quite as sharp as some of the other areas in domestic equity markets, though. But the Nasdaq and the small cap space really as a whole, the Russell 2000, have been among the sharpest decliners that we've seen over the course of the past week or so. So definitely going to want to continue to monitor some of these support levels for the S&P. But in looking at the Nasdaq, that is the 100-point chart we want to be looking toward there, kind of that more intermediate to longer term view of that index movement. And we see a similar story, but more amplified movement to the downside. So that index move has now given two consecutive sell signals on that 100-point chart for the Nasdaq Composite, ticker NASD on the platform for those following along. We broke through a pretty notable support level, had a spread triple bottom break on that chart at the 14,200 level last week on Friday. That was a level that we got down to in October of last year. We got down to in July of last year. It held both of those times, and we saw that violated with movement on Friday last week. Seeing the movement this morning, Nasdaq down another 3% at the time of this recording, which is going to push us down to a chart level at 13,400. So the next real notable support level that we can see for the broader Nasdaq Composite Index is going to be down at that 13,100 level. Similarly to the S&P 500, we're pretty heavily oversold at these levels here, going to be north of, or I guess south of 100% oversold with a weekly OBOS reading at an intraday OBOS reading down beneath that negative 100% level at the time of this recording. That 13,100 level is about 18.5% decline from the all-time high that we saw for the Nasdaq back in mid-November. So be interesting to see kind of monitor that support level moving forward as we're getting down toward that 20% threshold. That 18% is going to be a notable place to continue to monitor there at that 13,100 level. The Nasdaq is made up of mostly small cap stocks, and so we've seen that the small cap deterioration really kind of amplify that movement lower. You can also see that small cap deterioration, David, we were talking about on the Russell 2000 index, ticker RUT on the platform. That index is pushed lower at a pretty notable support levels that we've gotten to kind of move really largely sideways, looking at the 20-point chart of RUT, largely sideways, pretty broad trading range, but largely sideways throughout most of the movement last year after the kind of March timeframe. And we broke through that level, falling down to a chart level of around 2,000 at the time of this recording. falling down to around 2,000 on Friday, rather, and then pushing a little lower down to the bottom of the trading band at that 1960, 1940 level, which is also going to be support from January of last year. So no shortage of kind of technical movement lower that we've seen from an absolute perspective on these broad index chart pages. But one kind of final thing that we did want to touch on here before we look at some of the relative strength picture is that we're seeing the participation to the downside for those names in the Nasdaq Composite is among the most participation lower that we've seen on any market movement day. And there's not really a specific catalyst. I mean, there's a lot of things factoring into this price movement, but we're seeing taking a look at just a number of stocks in the Nasdaq Composite that are marking a new 52-week low. We were at over 1,300 or 1,315, marked a new 52-week low on Friday. At the time of this recording this morning, we're up north of that, up north of the 1,500 stocks, which is going to be almost half of the stocks, 40% of the stocks really there in the Nasdaq Composite. And we've only seen a handful of days that have seen this much participation lower. These many names marking new 52-week lows. So that you're looking at timeframes back in August of 1998, in October of 2008. And then in looking at the March of 2020 and then the December 2018 timeframe are the only other times that we've seen at least 1,100 new lows in the Nasdaq Composite. So a lot of these names are getting pretty heavily washed out. Definitely wouldn't necessarily be looking to jump in and start buying because obviously we saw some pretty significant deterioration to the downside on Friday, and that's been followed with some pretty significant further declines here on Monday. So definitely be sure to continue to monitor some of these indexes and some of these participation indicators. If we do see some demand return to the picture, could be an interesting opportunity to look towards from there. But we are seeing some notable relative strength deterioration too, specifically from the domestic equity asset class there in the Dolly rankings, aren't we, David?
Absolutely. The domestic equity ranks, especially under the hood of domestic equities over the past 2 weeks, have been extremely active. And what we mean by that is we've seen these signals switch around quite a bit within domestic equities, and that's transitioned into ranking changes. Notably, especially over the past 2 weeks, we've seen the U.S. size and style rankings really see a tremendous amount of shakeup. And much of that's been to this value improvement that we've seen to start the year. And we actually do see a value group sitting at the top of the size and style rankings for domestic equities. Mid-cap value holds that top position. And it's the very first time since 2007 that a value group has held that top position within the size and style rankings of domestic equities. And in a lot of ways, you'll hear us mention these stats. A lot of these stats that Ian and I both mentioned, whether it's been about the Nasdaq Composite, new lows, or value being a top ranking group within Dolly for the first time in over 14 years. This is somewhat of what we're getting at, is the fact that this time is a little bit different in what we see versus 2021, when we saw value resurgence. And this time we're seeing things change in rankings, such as the Dolly size and style rankings. And while we've seen value groups and also small cap values picked up, large cap values, the most improved group from a signal basis over the past 2 weeks, we've seen those value groups increase. We've also seen the growth groups decrease. And that's been very significant because it wasn't really more than a week ago that mid-cap growth and small cap growth were sitting there at number 1 and number 2 within the Dolly size and style rankings. And now they're currently sitting in the 4th and 5th positions. So seeing a lot of changes go on there within the size and style rankings. Additionally, we have also seen changes go on within domestic equities on the sector front too. We've seen energy move up into that second position while technology's fallen down to third, and consumer cyclical sits in that 4th position. Some jockeying had been occurring with industrials and real estate and energy, but really energy's emerged as the leader among those 3 now, and real estate's backed off a little bit. And the last thing we'll mention within Dolly, and this is probably the most noteworthy thing that we'll mention about within Dolly through this whole thing, is we've actually seen domestic equities fail its bogey check following Friday's action. We've seen enough negative action within domestic equities to see it fail the bogey check for really the first time in quite some time. And that's going to be the last time we saw it was March of 2020 was when domestic equities failed that bogey check, and it actually did well as far as when we look at the relative strength chart there. It actually reversed down in the latter part of February and reversed back up in the latter part of March when we look at that relative strength chart for the bogey check for domestic equities. Now, when we dive under the hood, the interesting thing to observe is that within the cash percentile rank, we still have a fairly low cash percentile rank, even with the bogey check failing now. And actually, Ian and I were talking about this. Oftentimes, the bogey check is the first thing to fail within domestic equities. It's had its fair share of times where it's been great, and it's had its fair share of times where it's not panned out. But the times that, and especially in our past two occurrences, when we look at the bogey check, the reversals down in 2018 as well as the reversal down in 2020 worked out very well for getting out of the market, basically saying overall the asset class is weaker than cash. And then when the asset class has been able to rebound and show strength relative to cash, it's been fairly good to get back in as well with this bogey check. But again, we still see a somewhat muted cash percentile rank at 12% there. Many of the things that you would imagine that rank below cash are the things that have ranked below cash for quite some time. So not too surprising there. But as we've talked about in much of today's podcast, it's paying attention to what's breaking down, if it's broken down, where are we seeing these breakdowns coming from, and if we need to trim, if you're seeing significant key levels of support violated, or if you're, doing a strategy that runs something relative to cash, if you're seeing those relative relationships reverse down and those key levels of support violated on charts, those are things that are calls to action that we would look to address, as obviously we're seeing enough downside action within the market to warrant some action occurring. We'll obviously keep you up to date on any further action that might occur, but we have, as we've discussed, seen significant breakdowns in the Nasdaq composite as well as the Russell 2000. We now have a bogey check fail. We see rankings shifting around within Dolly to the extent that we now see value groups being favored over growth groups. So it's been quite an active 2 weeks, and that couldn't be understated by any means.
Yeah, absolutely, David. And I don't know about you, David, but I think a lot of the conversations that I've had with individuals and been calling in, kind of wondering about seeing some of these breakdowns, seeing some of this stuff happen. Prior to kind of movement today, a lot of people are kind of like, well, is it time to start buying, right? We've been talking about we need a 10% correction. 10% corrections are healthy for the market. Been talking about that for 18 months at this point. And now we're here and everyone's kind of, what do we do now? But in looking at it, that's kind of why we have these indicators. That's why we have these different readings that we can look toward. Because when you're faced with some of the times like this, you can kind of take a step back, just look at the broader technical readings that are given to you and have that provide an indication of what to do moving forward. So I think sticking to the game plan is really going to be the name of the game here moving forward. And keeping an eye on some of these participation readings. We're seeing some notable relative strength breakdowns there, and that's not something that should be ignored, exactly like David said. But every, there's not any kind of perfect indicator, I guess. It'd be great if there was, but like David said, the bogey check is designed to be that first thing to go, but it's designed to be, by nature of that, it's going to be wrong more often than it's right sometimes. So, you're looking at a bogey check in the prior, since 2005, there's been 10 flips for the bogey check. And you're looking at about a 58% positive hit rate on an annual basis, looking at when that is flipped. So there's some big outliers in there. There's some big movements, March of 2020, late 2018, that the bogey check worked out pretty well, but there's some other time frames where it didn't. So I think taking a step back and sticking with the game plan, whatever that game plan is that you've generated there for your business is going to be really important here moving forward.
That it will. And it's to the extent that was actually something we had on our analyst meeting earlier today, was really talking about that game plan, and that being the biggest thing. And that's when we tend to see folks having the most questions, is when there's been a deviation from that game plan. And as long as you know, in the case that right now you're seeing these breakdowns on these charts, you're seeing bogey checks, so on and so forth, you're seeing the evidence mount to the extent that we're getting enough negative action to warrant some, some potential trimming in some of these positions, or possibly selling away, depending on what it is. But you're starting to get a lot of this occur, and if you're going to change your game plan for that today, then what does that mean for tomorrow, and what your game plan is then. So I guess that will be our final message to send people off with, is stick with the game plan.
Absolutely. No better message, I would say, certainly. So yeah, with that, I think that does wrap up most of what we were looking to cover here on this this significant Monday for sure. So we'll continue to keep you all up to date on any kind of market movement we're seeing through the daily equity report for those that are subscribers. We'll also be doing our weekly analyst rundown of all the sector movement and asset class movement we'll be seeing there on Wednesday morning. So keep an eye out for that as well. And as always, if you have any questions on anything that you're seeing, any of the indicator changes, you're more than welcome to reach out to us here at the Dorsey Wright. Phone number is 804-320-8511, or shoot us an email at dwa@dorseyright.com. So thank you all very much for joining us this week, and we look forward to having you back next week.